Hello my fellow freedom builders and welcome back to the channel. Today we are gonna have a trip down the memory lane. We're gonna have to jump into the time machine and travel back 33 years to October the 19th, 1987, where we had the big crash where Dow Jones dropped 22.6% in a single day. We're going to have a look at the charts. How does a drop like that look? Could we have predicted it with just the standard strategy that I normally use? Then we're going to have a look at if it could happen again, because that is of course the big question. Could it and would it happen again today? And what are the pros and cons in this debate? So first of all, let's have a trip down to 1987. We are back at the times where my hair looked quite funny. I had just started investing. I was 14 years old in 1987 and I had just put my first money into a stock, and then the market crashed. Luckily, I didn't notice that until 2 or 3 days later, because there was no internet, and there were no cell phones, and there were no nothing pretty much except from a real paper. You know, the reason they call it paper is because it was made of paper, and it was delivered in the mailbox, and 2 or 3 days later I opened an old version of the newspaper and saw that the market has dropped, and I could see that my stock had dropped with it. So that was the times where news like this were delayed by several days and couldn't be glanced at your cell phone in seconds. But let's have a look at the anatomy of this drop, because what we had seen here was in the 1980s. Here we had seen a huge bull market here, and as you can see, I normally draw these trend lines here below the market, and as you can see, it had accelerated to a point where it was pure madness, and in just the last 11 months here, the market had gone up something like 65% or something like that. So already there, of course, we would have been cautious, but we all, or at least I always wait until the market shows us that we will go down before I start to sell. So when would we have seen that here? Well, just by drawing a simple regression channel here, we could have seen that it broke out already here in the beginning of October. Now, in 1987, you could not have drawn a regression channel like this. You would have had to calculate it by hand pretty much and draw it on a piece of paper, and it would have taken me something like a week. So there are a lot of possibilities here today that at least I didn't have at that point. A computer I could use for trading would have costed $10,000 at that point. And then if I had ordered the luxury version, I would get the data on a 5¼ floppy disk every Sunday. So once a week I could have updated my charts. But as we see here, the trend breaks out of the regression channel, and if you know my entire strategy, you would know that what we're looking at a daily chart would be a drop down here, a lower top, and then a breakout of the regression channel. So we would pretty much have been out here up around 2400. Remember, this is the Dow at 2400. So when you read that the Dow dropped something like 500 points, well, that was another time. Then the market dropped. These days here we had some huge losses, and then it fell 22.6% in one day. It was actually lower down, but it was reduced a bit. Now remember, at this point, the algorithm trading were just in its orphanage here. It was just in the very beginning, and it was very immature here, and that was one of the reasons why we had this drop. There has been a lot of speculation as to why the drop happened, and of course there was some skewed economy. It was really pumped up, and we had started to see some really bad numbers coming out. It was all inflated so much, pretty much as we see it today. But the thing that wasn't there was all the regulations on the stock exchanges, because today, if we see a huge drop, we have some circuit breakers jumping in. If we can see that the stock market drops, I think it is 7% after opening, we see a circuit breaker where the market is halted for, I think it is 15 minutes. Then if it happens again, when the market is restarted, the circuit breaker steps in again and there's a 1 hour recess, I think it is, and if it happens the third time, we simply see the market closing for the rest of the day. That gives all the programmers, all the algorithm guys, it gives them the time to see if their algorithms are running wild, if they should adjust something. And that is one of the reasons why we haven't seen drops like this, because the overall economy is pretty much as bad now as it was back in 1987. But we do have a lot more control with the algorithms. I know it doesn't always seems like that. And of course, it will be possible with a drop like this. Of course, the circuit breakers will step in, but then maybe we could see it over several days where the market simply just kept dropping. So it is possible, even though it is not probable. And that is one of the things I'll have a look at later in the video. But this is how a drop looks like. And as you can see, from a top to a bottom here, we see something like a 40% drop, pretty much like the 35% drop we saw here in the spring 2020. This just came with a bit more of a warning, whereas the drop here in 2020 just went from an all-time high and then into a steep drop of 35%. So we would have gotten out here just as we did here in 2020. I got out with a drawdown around 10-11%. And as we can see here, the market just slowly recovered, not with the same speed as here in 2020. So it took something like from the top here in August 87, it took us to August 89. So 2 years it took for the market to recover to recoup the losses here, and then it went up from there. If we take the time machine a bit up in time here, we can see that the big .com crash in 2000, that was actually a lot, you could say, easier to predict, or at least to avoid, because it was much more of a broad top formation we saw here before the market turned down. So that was, I don't know if you could say easy to see, but it is possible, and I came out with these basic strategies. The same thing here in 07 and 08, you could see a top forming, and there were several instances where we could get out and maybe even short the market. So it is possible. The thing is that the drop we have seen here in 2020, there was not really any warning, and of course that was due to the virus. We simply just had a higher top, an all-time high here, and then it went into a steep dive, and it was hard to get out here. We have almost recouped the losses now, and this is where we stand today. So let's just have a look at if this could happen again. There is a circuit breaker issue, and maybe it could happen, maybe it couldn't. There is one thing that I found an article about here, and that is one of the reasons why it could happen again is that many stock investors are too young to remember Black Monday in October 1987. Now, I hardly remember it, and I was 14 years old at the time here. And this article speculates that when we get far enough from some of these huge drops here, we tend to forget them, or at least tend to tell ourselves that this could not happen again. I know that it did here in the spring of 2020 due to the virus, but many people tell themselves, well, that was just due to the virus. It was not a real black swan, but at least some sort of gray swan event. It was something that was unpredictable right now, and we have gained all the loss. So people tend already now to try to explain it with some outliers, and it didn't really happen. It was just the virus. But just remember that the farther we get from these instances where the market drops out of the blue sky, the more likely it is that we just tell ourselves that this was sometimes back in history. That was the time where it was real papers, and when the pictures was in black and white and weren't moving at all. So that was ancient times. It was only 1987, but still, this article tried to speculate how this is actually a disadvantage for us that there's not really any traders alive that does remember it, and that was live traders on the floor on Wall Street in London back in 1987. Of course they are alive, but they are just about to retire. So that is one thing we can take away from this article. I will link to it below so you can so you can read it for yourself. But the thing is that when you have no recollection of large crashes, then you tend to take more risk. And when you are hired by some sort of brokerage house where you get a bonus if you take a lot of risk and make a lot of profit, but you are not heard the same way, it's not your own money you lose when you loses, then people tend to take a lot of risk, and there are something about that in this article as well. So it's a very good article. I recommend that you read it to get a feeling of that. Now, another reason why at least there are some signs that this could happen in some way again. We saw that already here in the spring, and that is because of this. And I know that you might run away screaming if you don't like math too much, but this is the Black-Scholes formula. And this is pretty much a formula telling how to price options in the options market. But people are, the financial world has gotten a lot better at predicting risk and calculating risk and pricing risk in the market. The problem with these formulas are that they are based on what is called a bell curve. And you might have heard about this, and what we see down here is what is called standard deviations. And that is a statistical concept where we are saying that we have we have an average here of the data we have collected. We have a lot of data collected, and here is the average, and then we have some standard deviations. When we go one standard deviation out, there is a 68% a chance that or at least 68% of the data points will lie within these two parameters here. When we go out to 2 standard deviations, we have something like I think it is 97% of all the data that is included. And then when we go out to 3 standard deviations, we say that around 99.567% of all the data is included in this area. Now, the problem with this is that in the financial world, everything that lies outside 3 standard deviations here is pretty much considered impossible to happen. So it is not just improbable, it is pretty much impossible. And that is where one of the big risks in the financial market lies, if you ask me. Because we saw in this spring in 2020 that we could easily drop down by 4 or 5 standard deviations, but the pricing is simply not, or the risk is not priced correctly in these outliers. So when you ask people if this could happen in the financial market or anywhere else, people simply say, no, it is impossible. For instance, I had a debate the other day that was about the presidential election in the United States, and we were talking about what would happen if Joe Biden died before he was elected, and what would they do, and so on. And we were talking about who would be the president then if he was elected and then died, and we were talking about how probable that is. And the people I was debating with in a Facebook group said, that is impossible. And I said, no, it is not. It is not likely to happen, but it is possible. So how would the system cope with that? And they kept saying that that was impossible, even though it was actually a line of events that, of course, unlikely to happen, then it was actually possible for them to happen. And they kept saying it is impossible, even though I knew that there was a very, very, very small percentage likelihood that it would happen. And that is the exact same thing I find in the financial world when I talk to people, when we're talking about if something is possible to happen or probable to happen. And there's this line of event here from absolute certainty to not expected. And for instance, I could say with certainty that the sun will rise tomorrow, or I could say with certainty at least some sort of 99.999% that the market will open tomorrow. I could also say that it is expected that there will be movements of plus or minus 0.1% in the stock market. And it is even probable that we can see plus and minus 3 or 4%. And we would say that it is possible to see a -5 or a -10% in the market. -20% tomorrow would be not expected. But not expected does not mean that it is impossible. It is not just within the frames we normally look at the world at. So in the financial world, we would normally say that not expected equals impossible. Where I'm going with all this, I know it is a bit theoretical, but the place I'm going with this is that when you look at your own investing and your own trading, then many people are doing back tests and they are saying, well, could my system endure a drawdown like the one we saw here in 2020, or could it endure the financial crisis in 2008? And what I suggest you do is that when you look at your system and your strategy, you take your back test result and you're saying, well, I can see that I'm having a max drawdown of, let's say, 15% if I use this strategy over the last 10 or 15 years. I would suggest that every time you look at your own data, you double the max drawdown, meaning that you double the max risk. And you might say, well, that is not to be expected. No, but it is absolutely possible. So you should always expect worse than what is possible or probable in the market. You should also always take your risk management and your strategy and plan it in a way so that you can endure double the drawdown as what you think is possible. That's my suggestion. I know that it will cut a lot of the upside as well, because if you want to cut your position sizes in half, of course that it will also cut your upside in half. That is natural, of course. But the thing is that if you want to survive as an investor and a trader, and you want to survive 10, 20, 30 years in the market, you should be prepared for these outliers down here where everyone in the newspaper and in the media and then Facebook forums would say that is impossible. Then every time you hear that, you should think, no, it maybe it is not likely, but it is never impossible in the financial world. I have been here for 33 years and I know that I have seen things I would swear before I saw them with my own eyes, I would swear that is never going to happen. I had never thought I would see a spring like the 2020 here where we dropped 35% in a matter of, no time without any top formation. If people had asked me, I would say, well, it's not likely we are going to see that. And the same thing when you see predictions in the newspapers and read some analysts, maybe hear me say here on the channel and saying, well, I don't think we'll see a drop of more than 10% over the next year. Now, personally, I would never predict something like that. But if you hear gurus, experts, analysts on the internet saying, well, 10% in the next year, that will be the max drawdown, then you should at least in your head double that and say, could my strategy endure 20%, maybe even 30%? If it can, you have a long-term strong, solid strategy that can endure the craziest of times. And believe me, at some point, we will see something like this again. Maybe not 22% in one day due to the circuit breakers and all that, but we will see intense and absolute brutal drops in the stock market that the expert would say that was not to be expected. We had never thought we would see something like this. So my point here is, yes, this will happen again in some way, not in the exact same way as in 1987, but it will happen and you better be prepared. It might happen tomorrow, it might happen in 25 years. I have no way of predicting that. But as soon as we're talking about the financial market, which is a chaotic system, then things will happen that no one had expected, no one had predicted, and it will happen at the time where we would think it was less likely to happen. That's my warning to you and my little learnings from this history lesson back from 1987 where I was 14 years old. Take care of yourself, take care of your money out there, and I'll talk to you again very soon. Bye for now.